All right. Hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. And with me today, I'm happy to have Rich Howe. Rich is the founder of stockspinoffinvesting.com. Rich, how's it going?
Hey, doing well. Thanks for having me on, Andrew. I'm a big fan. So this is fun.
Hey, you know I'm a big fan of yours. I'll get to that in a second. But let me start this podcast the way I do every podcast. First, a disclaimer to remind everyone that nothing on this podcast is investing advice. Please consult a financial advisor, do your own work. This isn't financial advice. And then the second way I started every podcast is with a pitch for you, my guest. This is actually going to be the easiest pitch I've ever done. You know, spinoffs are always an interesting area of the market. If you're looking into spinoffs, the only spinoff subscription service I do is stockspinoffinvesting.com. I'm a very happy sub, does great work. I say every spinoff that comes out, you've got a write up, you've got a thesis, you've got a model on, some you'll say are interesting, some you won't, but every spinoff you cover it. And I think you do fantastic work. And what is the price of a subscription these days?
So let's see. It is $6.29 for an annual subscription, and it's $67, kind of random numbers for a monthly subscription.
Yeah. Well, I've been a subscriber for a year and a half, I would say, and I love it. So hopefully that's as good a recommendation as I can give. But all that out the way, let's turn to the stock we're going to talk about today. It's funny we're having you on for the first time for this one, because this is not a spinoff, though there are event spinoff-y type qualities here. The stock is NexPoint Diversified. The ticker is NXDT. And all that out the way, Rich, I'll turn it over to you. Why are we so interested in NXDT?
Yeah, thanks so much, Andrew. So yeah, it's funny. So, I mean, my site is named stockspinoffinvesting.com. I cover all the spinoffs. That's my primary hunting ground. But at the end of the day, I'm just looking like everybody else for good opportunities. And more often than not, it's going to be in a spinoff or in a special situation. And so NXDT is a good example of a special situation that I think is obviously pretty interesting. So just to take a step back at a high level, one of the reasons why spinoffs are so interesting is because essentially you have a chance to be buying something that is being indiscriminately sold. So if you do your work ahead of time and you can, value the spinoff, and you come up with a fair value, you can determine what you think is a good price to buy at. And you're oftentimes buying from shareholders who have just received a tiny spinoff, didn't choose to invest in that spinoff, and are more likely than not going to be sellers at the end of the day. And so it's a really kind of interesting setup. Not all spinoffs work. Many don't work, and some go bankrupt. But it's usually kind of an interesting, inefficient area of the market to look at. And the reason why NXDT is also interesting is because it has kind of a similar dynamic in that it's really right now it's an orphan security. So currently it's a closed-end fund, even though it's actually the name is diversified REIT. Currently, right now, it's a closed-end fund. There aren't many natural investors for closed-end funds. Closed-end funds are generally sold. They're not bought. It's kind of, maybe like an annuity, where when a closed-end fund has an IPO, usually the brokers, whoever sell the IPO, get a big, 5% commission because it is so profitable for the underlying manager. So long story short, NXDT is a closed-end fund that was launched way back in 2006. And it has been basically managing kind of primarily focused on real estate assets. But if you look at its portfolio, there's a bunch of kind of weird stuff, random equities, post-equity reorg, some distressed debt. It's kind of like a weird bit of a portfolio. And as a result of that, there's not many people that are interested in owning basically almost a micro cap closed-end fund. It has a market cap of about $500 million. But the thing that's so interesting to me is that it's going to transition from being an orphan security to a non-orphan security. So I love these setups when you have a cheap asset and it's going to go from something that basically nobody has an interest in owning to a lot of people potentially having an interest in owning. And so basically, NexPoint has changed their name, so it's not a closed-end fund anymore by name. They're a diversified REIT, and they are in the process, and it's taken a while. I'm sure we'll talk about that, but they're basically going to be transitioning from being a closed-end fund to being a REIT. Basically transition from a closed-end fund to a REIT makes all the sense in the world. Usually closed-end funds trade at some sort of discount. And NXDT is trading at a 40% discount. Usually most REITs don't trade at a discount to NAV. They typically trade at a multiple of funds from operation or from EBITDA. So it's basically by essentially changing from a closed-end fund to a REIT, the security will be open to a whole nother class of potential investors that can basically invest. There's a whole other host of reasons why I think it's potentially interesting. But the biggest one is it's trading at a big discount to NAV right now, about a 40% discount. So if it were to revert to NAV, that could be a very nice 50% plus return there. The other interesting thing is the CEO of the company, James Dondero, has been it's almost like he's been buying indiscriminately. It's like every day he's in the market buying more shares. He owns about 14% of the company, so that's a very sizable investment for him. So at a high level, I'm happy to obviously dive into questions, but this situation seems like a low risk setup. You have about a 4.5% current dividend yield. It's trading at a big discount to NAV, and NAV has been growing, and they have some pretty nice assets in there. And then you have the potential catalyst, which I'm guessing will happen within the next 6 months, whereby they transition to a REIT and open up a whole swath of other investors, whether they're passive, index funds or individual investors who are interested in investing in the REIT. So that's kind of the pitch in a nutshell, and that's why I own it.
That is perfect pitch. Let's start with some of the more bull cases, and then I'll provide not that it's huge pushback, but there are some concerns here, right? So I guess the first thing you mentioned, persistent insider buying, and I just want to clean it up with something that I think actually makes it more bullet. It's not that he's in the market every day. I believe if you look since June, every day that the insider trading window is open, he's in the market, which I don't know if that's different than being in the market every day. Maybe that's more bullish, maybe that's less bullish, but I just think that's interesting. Like window open, the dude is in there, and this is not a super liquid stock. And I guess he's probably buying like the VWAP max that he's allowed to buy. Would you disagree with anything I just said there?
No, that's a really good point. I didn't even realize that he's just waiting till the insider trading window is open for him to participate. But it's that's exactly right. Yeah, he's not buying. It's an illiquid stock, but he's buying good chunks of stock. It's not like he's buying 10 grand here and there as kind of a window dressing event. I think at the beginning of the year he owned about 10% of the company, and throughout 2021 he's increased his stake to closer to 15%. So he's been doing some meaningful buying.
And I think, and again, you tell me if I'm wrong. I don't want to put words in your mouth or be too much of a softball host here, but I think a lot of the concerns and red flags around the company that we're going to talk about, and we're certainly going to address throughout the podcast, I think the answer to a lot of them can be, hey, the man who knows the valuations, the man who has the most insidery info into the company, every chance he has a chance to buy shares, it seems like he's doing so. Now, insiders know you can play the buy a little bit token buying game, get people interested, but it doesn't seem to be that. So I do think like people should keep in the back of their heads, because there will be some red flags we address, but I think that is like the overarching answer to a lot of those questions where you lean one way or the other. Again, don't want to put words in your mouth, but you tell me how you think about that.
Exactly right. And I think that's the biggest thing that's really giving me comfort here, because the assets there, I think this is part of the reason why there's a big discount and why it's been trading at a big discount to NAV. It's because there isn't a tremendous amount of granularity into what those assets are valued. As when you were prepping for the podcast, you mentioned that 80% of the assets are basically kind of valued, independently using kind of, comps and DCF and other metrics. And, I'm sure they're doing a fine job doing that, but it's not like they're just taking, it's not like they own 100 different shares of publicly traded stock and they're updating the NAV every day. So what gives me a lot of confidence is, I'm not a professional real estate investor, but the fact is it looks like it's trading at a big discount to NAV. It looks like the cash flows are real. And then a presumably pretty sophisticated individual is, as you said, pretty much buying, at any chance he gets.
Great, great. And I want to dive into the asset concerns you talked about in a second, but I do think there's one other area on the bull side that I think is worth addressing because, for event investors, this is a little bit before my time, but it's not that long ago. In 2014 or 2015, there was a company called NXRT that went from closed-end fund to REIT. The stock is up. Since then, it's up about 6x, whereas the Russell 2000 is up maybe 80%. Probably REIT indexes are around something like the Russell 2000. So this stock has been a screaming home run. And I know a lot of event investors who, maybe not made their careers, but made a lot on this trade. So NXRT has a lot of similarities to NXDT, the stock we're talking about. So I just wanted to give it over to you if you want to talk about those similarities and why that might have a lot to do with this situation.
Yeah, so essentially, it's kind of weird, but this was a closed-end fund, and it's the only time that I've seen it. But essentially, this fund, which had a different ticker at the time, actually
this fund being NXRT is what you're referring to.
NXRT or NXDT. Previously, its ticker was NHF, I believe. It actually spun out. It basically incubated this multi-family REIT, and then that became NXRT, which was spun out and, as you've said, has gone to be a 5X. So yeah, that's kind of in the background too. That and NextPoint controls that REIT as well. So clearly they do have some expertise in the real estate market. They do know how to add value. They've done it before. It's a little different in this case. NXDT, the company that we're talking about today, essentially is the parent of NXRT, which was the spinoff that spun off and performed incredibly well. We can kind of get into the strategy and what the strategy is going to be once this REIT conversion actually takes place. But from talking with investor relations, and there's not much that they can really share, but their strategy really is to continue to be an incubator and to kind of, reading between the lines, spin out additional assets like NXRT, which I think would help to close the gap to NAV.
Perfect. And let's use that to talk about, right now, as you and I are talking, the stock is between 14 and 14.50. This is a little bit on the liquid side, but it's liquid enough. Unless you're managing real big boy money, you can get a position here. But at 14 to 14.50, where's NAV? And then we'll dive into the assets and if you can trust NAV, if that makes sense.
Yep. So the market cap right now is they're about 37 million shares outstanding. So the market cap's about a little bit over $500 million. And I can't do the math in my head. I know the NAV per share is about $23.50, but the shares are trading a little bit above 14. So it's about a 40% discount to NAV on a per share basis.
Perfect. And that brings us to the first, I think there's two big questions here. That brings us to probably the first and most pressing of the concerns. Can you trust NAV? People can go look in my, I'll put my tweet thread in here, as well as a link to Stocks Spun Up Investing in the show notes. People can go look at my thread. I included a screenshot from the semi-annual report, or maybe it was from the Q3 fact sheet, but of the, let's call it $1 billion in assets is roughly what it rounds to. Of the $1 billion in assets, a little over 800 million, if that's the number we're using, of the assets would be level 3 assets. So a level 1 asset would be GE stock, super liquid. Every day you can go point to a price, right? A level 2 asset would be an e-liquid stock that you can point to a price, but maybe you wouldn't actually be able to get that price. But a level 3 asset it's a private equity fund. It's not traded. Now you can go model it, right? You can say, hey, we own a cable company. Cable companies in the public market trade for 10x EBITDA. We'll slap a 10x EBITDA multiple on it. Maybe we give it an e-liquidity discount, but there is no liquid comp for it. You are trusting a model for the valuation. So of the $1 billion in assets, about 80% of them are modeled valuation assets, is what I call them. So the first question to you, the most important question I think is that 80% of assets, do you trust that number? How do you gain comfort in that number?
Yeah. So first, first they do own a REIT, which they kind of IPO'd. They incubated and then IPO'd out of NXDT, called NextPoint Real Estate Finance. And so that accounts for about 16% of NAV. And so that is the part of the portfolio, the part of the NAV that is valued on a day-to-day basis. And essentially what they do is they basically, the NAV of NXDT fluctuates based on the price changes in that security. So you can, you can do research on that part of the portfolio. The market is kind of valuing that independently. The rest of the portfolio, we do not have much granularity into. In terms of the biggest parts of the portfolio, you have Vinebrook Homes, which is basically a single family rent to own operation. So they are single family. They own a portfolio of about 14,000 single family rentals, which they rent out across the Mideast. And so they're very similar to kind of like an Invitation Homes at a much lower scale than Invitation Homes. Invitation Homes is a lot bigger. This is the Blackstone entity that does the same thing. They buy a bunch of homes and they rent them out. Historically, this has been a very good place to be. Vinebrook Homes is a trust. It does file financials. And so with the SEC, so you can go in and try to get a sense of what you think this thing is worth. They also publish a monthly NAV. Again, it's done, I think, by Green Street Advisors or with input from Green Street Advisors. So, theoretically it's done by experts, but again, it isn't a market price. So I guess I don't have tremendous confidence I don't have a lack of confidence. I don't have complete confidence in whether that asset is necessarily marked correctly. Historically, or at least in the past year or two, the single family rental market has been a good place to be, as has most residential investments other than office or maybe retail. So I am comforted by the fact that it's been a good place to be over the past couple of years, and you do have a good comp in terms of Invitation Homes. The other big asset, which represents about 12.
Just before you go to the other big asset, if I can just pause you on Vinebrook. So I noticed they were not publicly traded, but they had public financials. You can go look it up. Vinebrook's Homes Trust, their SEC filer and everything. Feel free to say, I don't know to this question, but one thing that jumped out to me just glancing at their 8Ks, right, is they actually do issue stock pretty frequently. So I'm looking from December, they filed an 8K from December 2nd to January 14th. We issued 1.1 million shares for about $60 million. They issued it right around NAV. NAV is 53.54. They issued it about 53.54. My question is, do you know who they're issuing stock to? Is NXDT participating pro rata, taking all of this down? Are they issuing it only through, the brokers who are selling it to retail shareholders? I'm just wondering, $60 million is not nothing. Who's taking all of this that they're selling?
Totally. Yeah. Great question. And I don't know. Yeah, it's a great question. I'll definitely look into that. But it's also interesting that they're issuing it at NAV. Because presumably somebody believes that NAV enough that they're actually buying at that price. But I don't know. The short answer is I don't know if I don't think it's NXDT. I think they're kind of trying to conserve cash, but that's a good data point.
I suspect, and again, I have not done crazy amounts of work. I'm just glancing at the 8K. And when you were talking about it, I had noticed before. I suspect because they say we issued shares for $60.4 million in aggregate, and we also paid $2.9 million of selling commissions and fees in connection. I suspect it's to retail shareholders through brokers because that's about a 5% fee. That's generally what you see, but no guarantees in there. Anyway, you were about to talk about the other assets behind Vinebrook Homes before I so rudely interrupted you. Please continue.
No. That's a great point. And it's a really, really interesting data point. And I guess before I kind of go on, basically the majority right now, they're repositioning the portfolio so that they own really a bunch of different assets. The majority is real estate, but they've been trying to sell call it post-reorg, bankruptcy companies and other kind of random stubs that they owned and redeploy the proceeds into more real estate assets. So I think as of the Q3 NAV report, they had something like 70% of their assets in real estate. This is obviously what you want to do if you are transitioning to a REIT. But the one underlying message that I guess I want to come across is we already talked about the single family rental asset, but they also have basically a bunch of assets that are focused on, I think, just good places to be. So they have good exposure to single and multifamily residential. And then they also have exposure to basically self-storage assets, which has been, a really good place to be, historically, but also throughout the pandemic. So their next biggest asset is called NexPoint Storage Partners. They have about 12% of NAV is tied up in this. This is basically $1 billion storage platform originating company. It was acquired partly through an acquisition. Currently, right now, as of the mid-year report, they have about 52 self-storage investments across the US, and 41% of those are wholly owned. Historically, self-storage has been a good place, especially in the pandemic, in terms of different subsectors of real estate, but I don't have tremendous granularity or insight into whether or not these assets are marked appropriately. Any other questions, Andrew, before I go on to the next big asset?
No, I think that was great.
Okay. So the other big asset, which is kind of interesting, is City Place Tower. So those of you who are watching or listening who are in Texas, maybe you can check out this asset in person. But essentially, this is a tower in Dallas, Texas. It's a 42-story office tower that was acquired in 2018. It is, this, me being kind of a generic real estate investor, Dallas seems to be a good place to be. Business friendly, good climate, low taxes. It seems like people are
oil and gas coming back. Dallas is ready to rake in the cash there. Yeah,
exactly. And also like I was amazed that like taxes are really low in Dallas or in Texas. I didn't appreciate that. You have the good climate, so people, perhaps even entrepreneurs coming from California that want to come from go to a more business friendly state. And then you also have the headwind or the tailwinds from the boom in the oil and gas market. So it's a nice. It seems like it would be a good place to own real estate. The other interesting angle here that I picked up just from reading the historical annual reports is that this asset is in the process of basically opening an international intercontinental hotel. It's going to open in early 2023, and it is going to basically occupy about 8 floors of the 42 floors in the building. And there's a little throwaway line in I think it's the 2020 annual report that says that NexPoint expects NOI to double once the building is stabilized. And so again, I don't know how much of that was baked into the acquisition price in 2018, but presumably if NOI is going to double, you could see a nice pickup in terms of kind of asset value if, once that asset is stabilized in 2023. So that's the other, pretty big asset that I think is worth talking about. I think, one of the themes you've heard me talk about is I don't have tremendous insight, unfortunately, into whether the marks are accurate on this portfolio. It seems to be selling at a big discount. The stock seems to be selling at a big discount to NAV. But there are a couple of things that give me comfort, and we've already hit on one of them. But the first is that this is a fund that historically has traded closer to about a 20% discount to NAV. So most closed-end funds traded a discount to their net asset value. Whether that's 10% or 20%, 40% is pretty extreme. And I guess my point is the assets were valued the same way last year and the year before as they are today. So, even if you're not completely comfortable with how the assets are valued, I guess I get a little bit more comfort that the stock, the security is trading at a 40% discount today versus 20% pre-pandemic. So that's the first data point that gives me a little comfort. And then the other data point, again, is that we've talked about is that James Dondero is just buying kind of relentlessly in the open market. Again, he's increased his stake from about 10% of the company to about 14%, and he's buying really any chance he get. I don't think I presume he's a fairly sophisticated investor. I don't think he would be buying if he didn't have confidence in the marks. So those are the two points that really give me comfort, even though there isn't much granularity into, or at least I don't have much granularity into, the underlying marks on those assets.
Let me ask you real quick. You've mentioned twice the company used to trade at a 20% discount to NAV. And I think that's pre-pandemic is when it mainly traded for 20%. And now today, 40% discount to NAV. Is there anything that's changed particularly between, obviously there was a pandemic, I'm
Yep.
living here cooped up in my studio apartment, and everything, but is there anything material that has changed between now and then? Because you could say, hey, pre-pandemic, I'm just throwing out an example. I haven't looked at the balance sheet pre-pandemic, but you could say pre-pandemic, everything they did was they owned all publicly listed stocks, right? And they traded at a 20% discount to NAV. And then in the pandemic, they sold all those and they bought a bunch of illiquid private investments, and now it trades at a 40% discount. So you could say 20 to 40. And then I'd say, oh yeah, but now you're getting the liquidity discount and everything. So has anything materially changed between the 20 to 40%, 20% a couple of years ago to 40% today?
Yeah, a couple things have changed. So the first thing is NexPoint Real Estate Financial, which is their biggest asset. So that actually became public. So that went from being a level 3 asset to a basically level 1 asset. So that's you would say that that's a positive. The other change, and this is something that I think is really important, especially in the context of who would buy a closed-end fund, is the yield. So the dividend has been cut twice, and we probably should have talked about this earlier, but that is incredibly, I think that's really important. And I think that actually is a potential bull case that the dividend could eventually be reinstated a lot higher.
Let's talk about the dividend, because I think that would actually play more when we start talking REIT. So we'll talk about that in a second. But I do want to talk that asset that went level 3 to level 1. Again, like I do work for this podcast, but I didn't go through 4 years worth of history and stuff. And that does strike me as interesting in one particular respect. When it went from a level 3 asset to a level 1 asset, do you know how closely it kind of followed the pre level 1 asset valuation?
Yeah, it's so funny. I don't know that, but it's a phenomenal question. And I was actually, as I was kind of finalizing my notes for this podcast, that was on my list of something to do, because it would give you insight, right? The key point is it would give you insight into, are the other level 3 assets actually marked correctly? So that's on my list of things to do. But it's a great point.
Well, you and I will follow up on that offline, because I'm always interested. But look, people ask me all the time, like, hey, why do you write? Why do you podcast? And the answer is a lot of times it's stuff like that, right? When you say, when we do the interview, that question, it kind of sounds obvious when someone poses it, but when you're doing work on a company, like there's so many things you're thinking about, there's so many things you're doing, it's very easy to not kind of think about that. Like that's a real clear mark, but it's very easy to pass it over. And that's one of the great things about writing, doing these interviews and stuff. So just for everyone who's thinking about writing or coming on the podcast, that's one of the reasons to do it. Let's talk. Okay. So I think we went through a lot of the assets, and we're going to talk some other things in a second, but a lot of these assets, I do think one of the things people worry about is not just the level 3 nature of these, but a lot of the assets are, NexPoint controls this REIT, and NexPoint controls a lot of the assets that they're investing in. So there's 2 ways people are worried about there. We'll talk fees in a second, but fees on fees, fee layering is one way they worry, and we'll talk that in a second. Put that aside for now. The other thing people worry is not only do you have level 3 assets that are marked to market, but you have this controlled entity investing into other controlled entity. And, not that whenever you say controlled entity investing into the other controlled entity, anyone who's investing for a while, immediately the hairs on the back of their neck stand up, because they're like, oh, this is how I've been burned 100 times before. So can you just talk about that kind of risk right there?
Yeah, I mean, I think there's no way to get around it. So it definitely is a risk. And I think I think there have been maybe some corporate governance concerns in the past, with the NexPoint, and the fact that they are essentially managing a vehicle that's investing in another REIT. So by definition, you're essentially stacking fees. I guess, again, it goes back to this is a concern I think that the market's had for a long time. Historically, that return, that concern was priced kind of at a 20% discount to the NAV. Right now, it's priced at a 40% discount. So, my thought process is that is, it is perhaps reflected in the current share price. But it is a concern. I don't think there's any way that you can, get around that. I will say it is going to be an externally managed REIT, which is, a negative. It's going to be NexPoint that is going to be kind of managing the REIT, but they are capping expenses in the year following conversion at I think 150 basis points, which I'm not a REIT expert by any means, but I think is kind of in the realm of reasonability in terms of what external managers typically charge.
And I'm looking on the right hand side of my screen because I'm trying to remember. I mean, NXRT, which again, this is so many people. When I said we were going to talk NXDT, I had so many event fund people reach out and they were like, that's been on my list, including myself personally. It's been on my list because I remember NXRT. NXDT rhymes with NXRT. I've been meaning to look at it. NXRT is obviously they were externally managed. So that's one thing. Like you can have a screaming home run when you're an externally managed REIT. And I think when they spun, they had a lot of the same NXDT, like, oh, we invest in a lot of related party issues, and they cleaned that up over time, but I can't remember correctly. I was trying to get clarity on that. Do you remember?
Yeah, so it was and remains in externally managed REIT. The strategy there was essentially, that fund was incubated within NXDT, and then, but the strategy was really to basically kind of streamline the process, redeploy assets into multifamily, B class real estate, lever the assets up kind of appropriately. I don't think they were kind of optimally leveraged within the closed-end fund structure. I think that's part of the reason, when you're in a closed-end fund, your leverage is a little bit restricted. And so, that was, it was externally managed. It continues to be. And then there was some repositioning of the portfolio, which ended up, essentially creating value, creating net asset value and growing earnings over time.
Perfect. Yeah, this is just NXDT. It's one of the funny ones because I could paint two stories so easily for you. Like, you've heard of doing a post-mortem, right? Where you're investing in something, you say a post-mortem is, hey, if I die, if I lose on this investment, you write how you probably lost before it even happened so you can think through the risks. And here, the post-mortem is really simple, right? You invested into a controlled company that invests in other controlled companies, like boom, post-mortem writes itself. But the bull thesis writes itself too, right? NXRT was a 6X. It followed the exact same path as this. There were the exact same concerns. I would like a 6X, please, right? So that's pretty simple. I want to ask a couple other things, but I just want to hammer one other point home. NXRT, right? That was a big winner. Single family homes, B class, very simple story to tell. NXDT, if and when they get their REIT going, and that's a question, and we'll address that in a second, but if and when they get the REITs going, like they've just got a mismatch of assets, right? You mentioned the self-storage. You mentioned that they're invested in the private single family homes and everything. Like, what is they say that they're NX development. I think they kind of think of themselves as a spin factory for all these other things. NXRT's got roots here, but like that, you can't have a REIT that's a spinoff factory, right? So what is their strategy going to be? What's the core focus 3 years from now? If they become a REIT, what are we going to be talking about?
Yeah, so it's really, so in terms of, they haven't shared a whole lot. They did file a proxy when they basically wanted shareholders to vote in favor of the REIT conversion. And when they made that presentation, they, made all the points that you would expect that they would make, that REITs, typically don't trade at a discount, closed-end funds do. You get more analyst coverage, there's more liquidity, you get inclusion in all the indexes. But they didn't really dive too deeply into kind of what the strategy would be, other than saying that they were going to be a diversified REIT. I did, have a chance to catch up with IR recently, and, she couldn't give me a lot of guidance. And I think a lot of that, will come with time, but that they basically want to kind of continue. They view themselves as a little bit of an incubator, and that they're going to be, potentially, she referenced the NXRT spinoff and also the NREF IPO / spinoff. So she essentially, the guidance that I got was that essentially it's going to be kind of like a spinoff factory, going forward. Like it's going to be an incubator where they incubate new strategies and essentially spin them off to investors. And then one other point that I wanted to make before we move on is, you're right. In terms of the postmortem, it's a controlled entity investing into another controlled entity. As you said, the postmortem could write itself. What I like about this situation is that I think the downside is pretty limited. So it is trading at a big discount to NAV. It does pay a pretty decent dividend yield, about 4.5%. And it seems like, in following spinoffs, a lot of times the spinoff will be announced and everybody gets excited, the stock pops, and then everybody just kind of forgets about it. And I think it just seems like there's a lot of fatigue with this stock. People were writing about it last in 2020 when the initial proposal came out where they were going to transition into a REIT. And so I think there's a lot of people who are like, oh, I don't really care. This is never going to happen anyway. And so that leads me to believe that perhaps, even if this is indefinitely delayed, or perhaps it doesn't even take place, the downside's pretty limited. And so maybe you don't get the upside, but you don't lose a lot either.
Let's dive into that point. So I agree with you. This shareholders approved, NXDT was looking for approval to convert from closed-end fund to a REIT in August 2020, not 2021, 2020. So we're approaching 18 months that they've been going through it. I think they got approval around August or September 2020. So 18 months from then to now. That is the definition of, at this point, people are like, yeah, it's never going to happen. The market's just gotten fatigue on this thing, right? So the question to you is, why is this taking so long? When they got approval, they thought it would happen they thought they'd be done first half of 2021. We've missed that by a year. I haven't seen a ton of new stuff. I think the last press release they put out on the conversion was in October. So why is this taking so long? Do you think this is actually going to happen? And I think you already addressed this, but we can address it one more time. If it doesn't happen, so what? What happens?
Yeah, so I think, is it going to happen? I think it's going to happen. They continue to come out, every quarter and say, we're making progress. It's a little bit more delayed, but at the end of the day, I don't know, right? The company has talked to the SEC. They have provided the SEC, there's a process where they go back and forth with the SEC, answer all the SEC's questions, and the company, per IR, has basically answered all the SEC's questions, and there have been no more questions. So you would think that the spinoff or the conversion, would happen, at some point.
What have the SEC's questions focused on?
Investor relations didn't really articulate, but what she did say was, how long is it going to take you to basically reposition the portfolio to be kind of 80% plus focused on real estate. I think there were some questions about that timeline. The other questions, and then the other thing that they focused on was basically operating as a REIT. So right now they're kind of operating under the basis that they're going to distribute, 90% of taxable income, which I don't think is very hard for them to comply with. But that is, that's kind of the process as it's gone so far. The one other point that I will mention is that the proxy statement that was filed 2 years ago in 2020, summer of 2020, basically stated that, it could take up to, I think, Q2 of 2022 or summer of 2022. So it's not completely unprecedented. The SEC is a bureaucratic institution. To some extent, you're just waiting on them. So it has been delayed. It is a little bit disappointing. I think ultimately it does happen. But I think we already touched on it a little bit. If it doesn't happen, I tend to think, maybe the stock sells off because people are pissed. But I think if it didn't happen, it would probably be, the announcement would probably be in conjunction with, hey, we're doing, a big tender offer to buy back a bunch of stock, or we're doing XYZ to create shareholder value. And again, it gets back to kind of the insider ownership and the alignment there.
That actually brings me nicely to one of my final questions, share buybacks. I think this company has a decent history of buying back shares. They actually did some share buybacks in 2020 in conjunction with going through the REIT process. They did a really big buyback, which was also kind of interesting because it was not a buyback. It was a tender offer with an exchange where they gave out some prefs, 20% cash, 80% prefs. We don't have to dive into those mechanics, but they used it to retire like 15% of shares outstanding at a nice discount to book. Very nice trade, especially if you believe book, if you think this is going to trade at NAV when it goes to REIT. Right now, they are not buying shares. So my two questions, and you kind of addressed the one angle of it, was why are they not buying back shares? Does that have something to do with being stalled out by the REIT process? And if they can convert to a REIT, or if they can't convert to a REIT and they continue to trade at a discount, do you expect they'll buy back shares going forward?
I do. I think they will. I do not know exactly why they're not buying back shares in the market. On the one hand, you could think, maybe for some reason, due to the transition to a REIT, they're prohibited from buying back their own shares. If that were the case, I don't know. Maybe you would think that insiders would be prohibited from buying as well. I don't know, but I don't know. It's interesting. In 2020, they were buying back, shares hand over fist. Right now, they're not. I don't know exactly why they're not able to do that, but I assume it does have something to do with that, with the conversion process, because they've been very consistent in their messaging that, hey, we're trading at a big discount to NAV. We don't think that necessarily reflects fair value. We're going to do everything in our power to question, or did I cover it?
No, that was great. You were cutting out for a second there, but I think all that came through and you definitely addressed those questions. Last question, I want to rewind just a little bit and make sure we address this. Traditionally the issue with closed-end funds, and this is closed-end funds as a general, not NXDT specific, is a closed-end fund because it's not a mutual fund where you can redeem if the manager is bad. Closed-end funds are basically locked-in fee streams unless an activist comes and tells them to liquidate. And everyone knows if you're paying a manager 1 or 1.5% just to manage what looks like a mutual fund or something, like just go do a Vanguard ETF. So closed-end funds generally trade for a discount because of that management fee stream. The NXDT is a little different because you can't exactly go buy an index of all the different like little non-operating. These are publicly traded investments. So they charge about 1% annually, 20 basis point, 1% management fee. I think like 20 basis points to cover other custodial things. They pay their board trustees pretty well, but the fees are not crazy here by any stretch of the imagination. However, so I'll give you that part of the answer, but yep. I do think a lot of people say, yeah, they're not crazy, but they're also investing in related party entities, which then charge fees. So when you look at the whole thing and the whole dominoes, like the fee stream gets pretty high. I know some people were asking, like, what's the look-through fee stream if you include all of those assets? I don't know if you know that answer, but I just want to talk about the fees and kind of that fee layering concern.
Yeah. So yeah, I mean, it definitely is a concern. You articulated very well. Essentially, they're managing, call it 900 million assets, $1 billion of assets. Many of those assets are invested in, other REITs that they're also charging fees on. In terms of the total, I guess from my perspective, where I come out on this is, I mean, I would prefer that they didn't do that. I guess a couple points here. The first point is that, yes, they are charging double fees. If you're charging double fees as a closed-end fund, why not just not bother converting to a REIT? Like, why not just continue to charge, double fees? Like, why even bother going ahead and converting to a REIT and trying to increase shareholder value if all you really care about is that fee stream? So I think that's point number one. Point number two is they have, historically spun off, either through IPO or pure spinoff, some of these kind of related parties. And it seems to me, based on my conversations with the management team or with investor relations, that is going to be part of the strategy going forward. So you're going to be getting rid of, if they do that, you will be getting rid of the double layer of fees. And then you also, if you as an investor are getting a part of the portfolio at NAV, obviously the rest of the company's the gap to NAV is going to have to shrink because of that. So, the way that I think about it is it is a concern. I think, hopefully through spinoffs and other types of situations, other types of transactions, the double layering of fees goes away. But I think that's also why the opportunity exists. I think that's why it trades at a 40% discount. So I think, partially it's kind of reflected in the share price.
Last thing I want to ask you about, and then we'll kind of do closing thoughts and everything. The dividend, right? Dividends, like generally I'm very dividend agnostic. Honestly, I'd much rather see share buybacks because I think the things I own are undervalued and I love to see retiring shares. But dividends for closed-end funds can be nice because if they trade at a discount and they're paying out cash to you, like as you said, if they're spinning stuff off and all of a sudden you're realizing NAV, the discount, the gap kind of widens as you're getting that cash back, right? So the main thing I want to ask about the dividend instead of ranting about dividends, once they convert to a REIT, they've discussed what the go-forward dividend strategy will be. I know right now the dividend yield is about 4.5%, and that's one of the things you like about it. But once they convert to the REIT, the dividend will probably look different. So let's talk about, assuming they can convert to the REIT, what happens to the dividend, and we can kind of go from there.
Yeah. So first of all, so they've cut their dividend like pretty drastically. So I mean, as recently as as October of 2020. So really not that long ago. The dividend was cut. It's a monthly dividend, and it was cut from 20 cents down to 10 cents. That was really that step was really taken partially because, real estate assets, at that point we had no vaccines. People were still very concerned about COVID. We weren't, thinking that we're going to be seeing the end of it. And so I think, it makes sense to kind of retain liquidity a little bit and
Can I push back on that?
Yeah.
I hear you on that, and that would be one suggestion. But I believe, if I remember correctly, around the same time they cut the dividend, they actually ramped up the share buybacks. So your way of saying it could be one, and my way of saying it could be, hey, the shares were so undervalued, they wanted more cash to buy back shares. And the truth could be somewhere in the middle, right? Like companies can be a lot more flexible with share buybacks than dividends. But that's just another interpretation. And you can correct me if I was wrong there.
No, I think that's definitely, I agree completely that I prefer to see share buybacks and instead of dividends, in terms of actually increasing value, especially if you have an asset that you think is trading at a discount to fair value. So I think that's definitely a prudent use of cash. The other, in the press release that they put out where they talked about, why they're cutting the dividend, they did say kind of industry market conditions. They also said that they're transitioning the portfolio to a more higher quality portfolio, which isn't necessarily going to yield as high, generate as much cash flow, but they're higher value assets. But maybe the real reason was they were just like, hey, we think the stock's cheap, and all the stuff that they put out wasn't true, and they just wanted to buy back the stock, which I think would make a ton of sense. So that was the first one, and then they also basically cut the dividend again. So it went from a 20 cent dividend per month to a 10-cent dividend in October of 2020, and then a little bit later. So I'm looking for the date of this. They cut the dividend. Or no, the dividend was cut. I believe the second dividend was cut. So it went from 20 cents to 10 cents, and then from 10 cents down to 5 cents. Yep. The second cut was in October of 2020, and that was also kind of in conjuncture with basically that share buyback. But essentially, I think part of the reason why they cut the dividend, it was to buy back shares, but it was also because they were in the process of transitioning the portfolio. There were going to be some kind of one-time expenses in terms of transitioning from being a closed-end fund to a REIT. So I think they were doing in part to retain cash flow. And I don't have tremendous insight into kind of what the free cash flow generation of the business is going to be post conversion. But my sense is that they'll be able to pay out more than they were paying out, more than 5 cents per month, which could attract another whole stream of potential retail investors that are attracted to a REIT with a relatively high dividend.
The hope is you flip it from a closed-end fund to a REIT. That attracts a lot of buyers, right? It opens you up to retail. It opens you up to REIT indexes, maybe retail buyers who want a consistent REIT dividend come in, and then maybe you start increasing the REIT so you get in the growthy REIT indexes. Yep. And we've heard it before, and it can work out great. I've also seen it work out poorly, but it generally works out poorly when you rely only on the financial engineering and you don't have any real asset value there. Last thing I want to ask about NXDT. We've covered a lot. I'm actually surprised by how much we've covered. I think we did a nice job. But is there anything we didn't hit on NXDT that you wish we had hit, or anything that maybe we glossed over a bit that you think we should have hit a little harder?
No, I think we've hit on everything that really deserves attention. I'm not a REIT investor, so anybody on Twitter who wants to reach out and kind of share data points and kind of, give me bull cases, bear cases, I'd love to hear it. So would love feedback. I think the only other point that I wanted to hit on is just to provide some data in terms of what we can expect if the REIT conversion takes place. So I looked at all the REITs that are classified as diversified REITs from the North American Real Estate Investment Trust Association, so NAREIT. And I tried to, this is a little bit informal, but I basically just tried to dig up all the diversified US traded REITs and figure out how much passive ownership there is. And if you have a market cap that is below 500 million, even if you're a diversified REIT, there's very little passive ownership. But once you get up above 500 million to $1 billion, the passive ownership increases very significantly. So I think there was one REIT, I'm blanking on the name, I can look it up, that had a market cap of about 700 million or 800 million, which is where I think NXDT would be. And there was about 17% passive ownership based on, Vanguard or State Street and BlackRock. So I think, if this catalyst does happen, I think we are going to get in front of some indiscriminate buying pressure.
And just to hit your point home for you, right now, there's basically no passive ownership.
Exactly.
Yeah. So you'd be looking at, who knows, but if it gets into the indexes added, you probably get 15 to 20% of the shares need to be bought by the indexes. And then there's always some index huggers and followers who follow. And that's a real catalyst. People poo pot, people poo pot, but getting passive fund flows can certainly drive a stock. Okay, that's great. Hey, I've got two more for you. I'm going to put you on the spot. We haven't talked about these, but we might as well. You are the stock spinoff guy. I get your weekly Friday letter, so I'm leading the horse a little bit. But outside of NXDT, what is your favorite recent spinoff that you're kind of following?
Yeah, so the name that I like, so my biggest position is Jackson Financial. So I don't know if you've looked at that one at all, but
I've looked at it a little bit. I've also looked at Bright House BHF, which is a comp to Jackson Financial. And look, I love the thesis. I'll let you go into these, but I will just say, pull up the 10K and read through the accounting. My God, it's more like, to me, it's more a basket position where you want to play the event angle and the quant fund, but it's just hard to take a huge swing at it because the underlying assumptions, and it's just tough. But I'm sorry to rant. Please go ahead.
No, 100%. And I am not by any means an accounting, annuity expert, a life insurance expert. But the setup initially was really interesting because it was basically spun off from Prudential PLC, a UK listed company selling off a US subsidiary. So the setup was beautiful. It was, the ratio was perfect. It was, I think, for every 40 shares you owned at Prudential, you were going to get 1 share of Jackson Financial. And then,
do you want to just explain why that ratio is perfect for people looking for alpha? I know, but just to drive that home.
Exactly. Yeah. So say you own, so essentially if you own, if you own
400 shares, use 400 shares of Prudential for this. Yep.
400 shares of Prudential. Essentially, you're going to get 1 share of this tiny little crappy spinoff that is just a rounding error in your portfolio. Not only is it a rounding error, but it's a bad business, right? It's an annuity business. It's also trades in the US. You're a UK investor owning a UK company. You never made a decision to invest in this pure play American annuity company. So it's so essentially it's just a complete pure green black setup for kind of indiscriminate selling pressure. So that's the reason why there was a lot of selling pressure. Typically with spinoffs, you want to wait till at least 50% of the share count has traded before establishing a position, even if you think the stock's an attractive stock at trading at an attractive valuation. So this one was kind of a perfect case study for that. After 50% of shares started trading, the stock started to recover a little bit. The thing that was really interesting about Jackson was that they had initially telegraphed that they were going to be returning at its lows about 16% of the market cap through dividends and through share buybacks. I was hoping that a good portion of that would be returned through a dividend. I know buybacks are a lot better in terms of creating value than dividends, but in terms of a hard catalyst to force a stock to re-rate, dividends are amazing. Like with Contour Brands, we saw the same thing, with Jackson Financial. And the other reason why I was so excited is because Bright House has been buying back stock forever, and it hasn't done anything. It hasn't done anything for the stock price. And so my interpretation of that, it's incredibly simplistic, but it's basically nobody believes the earnings are real. To your point about what are all these accounting adjustments? If the earnings were real, you would have comfort paying out a dividend. You don't have comfort paying out a dividend, so you're going to use that cash to buy back stock. You don't think it's recurring. So my thesis was that signaling that they're going to pay a dividend would basically signal to investors that management had a lot of confidence in the cash flows. So the stock, is still trading at at 2 times earnings. It's trading at about 5.5% dividend yield. Bright House does not pay a dividend yield. It's been using its extra cash to buy back shares. Equitable Holdings has a dividend yield closer to 2.5%. So I think there's a lot of room for that yield to compress. And then they're also buying back a bunch of stock. So they've been buying back stock on a very accelerated basis. So that's one that I think, even though it's kind of hard to wrap your head around, it's still pretty interesting.
Look, I'm kicking myself because it's worked absolutely pitch perfectly, exactly how you said it was going to work. As you said, like, if I just look, it spun off, and I think the day it spun off, the share price was around 30. And by November, it was around, 25, 27. And as you and I are talking today, it's at 38. So from November to, we're talking on February 1st or 2nd, it's gone from 25 or 27 to 28 to 38. And by the way, markets have been in mini meltdown mode over that time. So it's like literally pitch perfect for why spinoffs, why forced selling, and all this type of stuff can really work. Last question for you, and then I'll let you go. We talked about NXDT, great idea currently. You said Jackson still remains your favorite past spinoff. There's probably about 8 spinoffs in the works right now, maybe a little bit more. Of all the spinoffs you're working, I know you start tracking and following them before. What's kind of the one not tradable today? It hasn't spun off yet, but what's the one you're most excited for, or kind of getting ready to track?
Yeah, so I mean, the cool thing about spinoffs is, like, you don't have to buy them all. You can wait for indiscriminate selling pressure. You can buy them before the spinoff takes place. You can buy them after. You can buy the parent or the spinoff. Like, you don't have to buy the spinoff. But I think one that looks actually really interesting is Bausch and Lomb. So this is
it's the most popular event desk name right now. As somebody who traffics in events, I can tell you that everyone is talking Bausch and Lomb right now. Yep.
So that makes me a little scared. Maybe it's not as good of an idea as I think. But the reason why I think it's so interesting is, the thesis in a nutshell is that Bausch and Lomb is basically going to be spinning. Bausch, I forget what the company is. BHC is going to be spinning off Bausch and Lomb, and Bausch and Lomb is a contact pure play comp for Alcon that makes eye care products, contact solution, contacts, consumables, other eye care products. And the great thing about that business is it's very durable. It's pretty defensive. Alcon trades at a really, really nice high multiple. And so the thesis in a nutshell is that, the EBITDA, the revenue that's going to be generated by Bausch and Lomb, the spinoff, is going to re-rate and trade at a higher enterprise value. And then the remaining company is going to be kind of like a specialty pharma company with very high margins, lower growth, but a lot of free cash flow. And the reason why if you run the math and you just try to figure out how much enterprise value creation this transaction is going to take place, it's not that much. It's not like the enterprise value is going to double or anything like that. Maybe it's going to increase by 10% or 15% or 20%. But the most interesting aspect of the way that they're setting up this transaction is they are basically leaving the vast majority of the debt with the parent company. So they're going to leave 6.8 turns of debt with the parent company, and the Bausch and Lomb, the spinoff, is only going to have, I think, 2.5 turns of debt. And so Alcon, I think, trades at about 21 times EBITDA. So the vast majority of Bausch and Lomb is going to be, of its enterprise value, is going to be equity. And one concern that I had for the RemainCo, for the parent company, was that if you look at Viatris or Organon, these are all recent spinoffs that are slow growth pharma companies that are trading at ridiculously low valuations, 5-6 times EBITDA. But by leaving so much debt, 6.5 turns of debt on this parent company, the market is forced to value it at least 6.5 times EBITDA. So maybe you get a half a turn for equity. So the market is going to be forced to value it at 7 times on an EV to EBITDA basis. And if you just run the math and you assume that Bausch and Lomb trades at, call it 20 times EBITDA, I think I get to like a $16 billion enterprise value or something close to. Then you subtract about $2 billion of debt, get you to $14 billion of equity value. And equity value for Bausch and Lomb right now, I think, is like 8. So presumably there's a ton of upside if they can if this transaction takes place. It's a big if. And one thing that I'm digging into is are the creditors going to basically sign off on it? So that's kind of the big if from my perspective.
Just to add to this, because I have not done crazy amounts of work, but I've had it pitch, and you just laid out a super compelling, super interesting thesis. Just to add to it, for those who don't know, Bausch Health, BHC is the ticker we're talking about. This is the former Valiant. And one of the angles that a lot of event people have gotten into is exactly what you're saying. Hey, are the creditors going to let them spin this out or not? And a lot of people say, well, almost all of the debt comes from back in the Valiant heydays where, Valiant was a high flying stock backed by Bill Ackman. $200 per share, was going to take over the world and revolutionize the pharma business. So a lot of debt was issued back in the high flying days. And guess what? High flyers get really good covenants on their debt. So a lot of the event guys have been like, hey, go dig through the debt and you could drive a truck through all the loopholes in the debt. So they're kind of saying like, look, they're going to be able to spin this out. And exactly what you're saying, you spin this out, you're going to, all of the current share price and more is going to be in the Bausch and Lomb business, which they've spun out. Yeah, the Stubco, I mean, there's just probably option value there, but it doesn't matter because the stock is 25. I think you get $30 on the Bausch and Lomb side. All the debt gets stuck at the current side, and maybe there's $1 or $2 per share or more if things work out on the specialty pharma co. But that's a really attractive trade if they can get this spun out, which is why the event people love it and they love to do work on it and everything. But this is great. Rich, this has been great. I think we've run overtime, which, sometimes asset plays can kind of go quick. So this has been great. I've had so much fun. Looking forward to following up on NXDT, stockspinoffinvesting.com. I'm going to include a link in the show notes. I'll include a link to Rich's Twitter account so you can go give him a follow, shoot him DMs if you want to follow up on any of the questions we talked about here. And again, we've got 8 or 10 spinoffs in the works. So I'm looking forward to having you on later this year to talk about the next one. Rich, Howe, thanks so much.
Yeah, thanks so much, Andrew. This was great.
Perfect.